All right, here we go. Let's do another activity. This is now activity 3.43. So for my grade 12s watching this, this is the one that you did today in class, and we're going to go through it together. So let's start by going to the textbook. I will periodically be checking that my microphone is still working the way it should be. It is currently working the way it should be now. Okay, so in the information it says you are provided with figures extracted from the financial statements of Guala Limited on the 30th of June. We need to do a cash flow statement for the year ended 30th of June 20.7. During the year, Guala Limited was able to improve their cash situation and pay dividends. Explain how they were able to do this when the net income decreased. I think we probably will not do this answer now. Let's just stick with the cash flow statement. So here we go. Here is our here is an extract from the statement of financial position, that is the balance sheet, and notes, that is notes to the balance sheet. So I guess this is a bit of a more summarized display, or what's the word? Presentation of the notes, of the financial statement and notes. I think this will actually be more user-friendly than the regular financial statements that they give us. That is the whole balance sheet with its notes separate. And here's a very small extract from the statement of comprehensive income. Wow, they really have made this easy for us. So let's just look at some important things here. We have a change in ordinary share capital. That could be from either repurchase of shares or sale of shares, or both. We've got a change in loan. We've got a change in our land and buildings. We've got changes in equipment. We've got changes in fixed deposit, changes in inventories, trade and other receivables. In fact, almost everything here is going to affect our cash flow statement. So let's see about the income statement. We've got our net profit before tax. We will use this figure, the 20.7 figure, not the 20.6 figure. We need the 20.7 figure. That is the end of the current financial year. And we've got our depreciation, and we need the interest paid, that is interest on loans. If we look at the additional information, it says the loan statement received from Umtata Bank reflected the following. We had an opening loan amount of 450,000, a capitalized amount of interest, payments made to cover the loan repayment and interest, and then balance of the loan. Now you can see that the balance of the loan at the beginning and at the end was a difference of 40,000. However, the payments in total was 91,000. So interest and loan payments together were 91,000. The change in the loan amount was 450 to 410, so it's 40,000. So if we minus that 40,000, the difference of 51,000 will be our interest that we paid this year. So over here I'm going to write 51,000. That's our interest on loan that we paid this year. Right, let's see what else we've got here. Equipment was sold at book value, 18,000. The cost price was 29,000, so that means that we had a proceeds. I'm just going to write here, proceed from sale of, oh no, that's not the proceeds, that's the cost price. What we need is to know what we sold it for. It was sold at book value. Cost price was 29,000. Accumulated depreciation was 11,000 at the date of sale. So we don't have to work out depreciation for the year in which we sold it, which means the amount we sold it for. Oh wait, it says here cost price 29, depreciation 11, so it was and book value 18. We didn't have to work it out. They told us the book value. So this book value here will be the proceeds from sale of fixed asset. Proceeds from sale of fixed asset in the cash flow from investing activities. Improvements were done to the office reception area. Yes, we saw the increase in the land and buildings. I'm going to write here land and buildings. That will be fixed assets purchased. I'm going to write here purchased, just so we remember. 687,500 Rand of ordinary shares in issue at the beginning of the year, 62,500 new shares issued at the beginning of the current financial year, 750,000 shares in issue at the end of the financial year. So let's just double check that we didn't have repurchases. We may have had repurchases. So we had 750 at the end of the year, 750,000. We're going to minus the 687,500, and we're going to see if that is equal to the 62,500 new shares. All right, so I said rands for 687,500. It's not rands, it's number of shares. Let me just do a little calculation here. 750,000 shares minus the 687,500 shares at the end of the year gives us a change in shares of 62,500 shares. Now the fact that we issued 62,500 shares and our change in shares, or 62,500 shares, tells us that we did not repurchase any shares. We only issued new shares. Interim dividends paid were 32 cents per share, while final dividends declared were 24 cents per share. I won't make the notes here, but that will affect our cash flow from operating activities. All right, let's go to our marking guidelines and see how this all fits into the cash flow statement. So the first thing we're going to do is the reconciliation note, which is note 1 to the cash flow statement. So remember, we need to do the 3 cash flow activities: cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. For the cash flows from operating activities, the first of the 4 things we need is cash generated from operations. And we are going to use note 1 for that. Remember, this is quite a long one, so don't get overwhelmed. It's the longest piece of the cash flow statement. The further you get into the cash flow statement, the quicker the various parts go. So here's note 1. Remember that the first thing we want to do is calculate operating profit before changes in working capital. And the way we do that is by taking our profit before tax and add back depreciation and interest expense. So let's find that information in what they gave us. Profit before interest and tax is given to us in this extract from the statement of comprehensive income over here, 1,100,000. Now we do not use the 1,500,000 because we need the net profit before tax of this year, not last year. We don't need this. We will then add back interest on loans, that's 51,000, and add back depreciation, that's 80,000. So 1,100,000, there it is, plus depreciation, 80,000, plus interest expense, 51,000. That will give us operating profit before changes in working capital of 1,231,000. There we go. First part of our cash flow statement is done. Now we need to add or subtract our changes in working capital. And working capital is inventory, debtors, and creditors. But remember, instead of debtors, we should say cash and sorry, trade and other payables. Sorry, instead of debtors, it's trade and other receivables. Instead of creditors, we should say trade and other payables. So let's start with the inventory thing. So inventory, also called trading stock. Let's go to our information here. Where's our trading stock? There it is. It went from 450,000 to 355,000. That is a decrease of 95,000 in trading stock. Now, if we ended the year with less trading stock than we started the year with, that means we sold more than we bought, which means we had a net cash inflow. Because it's a cash inflow, we will not put it in brackets. So 95,000, there it is, no brackets. Let's look at our trade and other payables. Trade and other payables went from 89,500 to 248,000. Let's see what change that is. 89,500 to 248,000. The difference is 158,500. It says that it is excluding items listed separately. So I just want to see if there are any separately listed items that we should know about. It doesn't look like it. Oh, listed separately in this list. Oh yes, for example, SARS income tax would be, it could be trade and other receivables or trade and other payables, depending on whether we owe SARS or SARS owes us. Also, our dividends, as shareholders for dividends, could also be we owe SARS or SARS owes us. Bank overdraft. Is that a trade and other payables? I don't know. We'll deal with bank overdraft momentarily. For now, let's stick with our trade and other receivables, which is SARS, which is debtors, SARS, shareholders for shareholders for dividends is a trade and other payables. We're looking for trade and other receivables. SARS income tax can be trade and other receivables if SARS owes us. But SARS is listed separately because we are going to use income. We're going to use that for income tax paid later in the cash flow statement. So all we need is this figure, 115,000 to 150,000. Oh, sorry. What am I doing? I'm just not focusing. What are we doing next? Increase, decrease in debtors, which is trade and other receivables. Man, I am just confusing the heck out of you guys. Let's go back down to trade and let's go up to trade and other receivables, not trade and other payables. We're doing trade and other receivables, which is things like debtors or SARS if SARS owes us money, rent income if rent income is owed to us, or rent income owed to us would be in the form of income accrued. Or we could have prepaid expenses, and that prepaid expenses. Now prepaid expenses and income accrued, that might be in this trade and other receivables line, but they don't need to break that down for us. They have taken out for us the things that need to be separate, and it looks like they have not. There is nothing. Yeah. There's nothing that we have to include in this or use separately. So 115,000 to 150,000. There was a change of 35,000 Rand. That 35,000 Rand is an increase in the amounts of money owed to us. Now you know that if the money owed to us decreased over the year, that would be a cash inflow. This is the opposite of that. There is more money owed to us, so we must consider it a cash outflow. 35,000 outflow. And there it is, 35,000 outflow. That's why it's in brackets. Now let's look at our increase or decrease in trade and other payables. They've got it here as creditors, but we should say trade and other payables. So let's go straight to our trade and other payables line and see the difference. For 89,500 to 248,000 is a change of 158,500. However, we have this line item that catches our eye as well, deferred income. Money that we received in advance, income we have received in advance. That is a kind of a liability to us and must be included in this item. That changed from 8,000 to 10,000. That is, this liability increased by 2,000. Both of these amounts of trade and other payables and deferred income, both of these liabilities increased from the one year to the next. An increase in a liability can be considered a cash inflow, just as a decrease in a liability over a year would be considered a cash outflow. The two of these together would be 160,500. So let's look at that in our cash flow statement. 160,500 increase in trade and other payables, not creditors. Now I want to point out that we have bank overdraft here. At the beginning of the year, it was 110,000, and at the end of the year, it's 0. But that does not affect our trade and other payables. So now that we have our changes in working capital, we can sum them, that is, add them together, and we end up with 220,500. If we take our operating profit before changes in working capital, and we add this 220,500 of changes in working capital, we find that our cash generated from operations is 1,451,500 rand. That figure we can now plug straight into our cash flow statement. There it is, cash generated from operations, 1,451,500. All right, let's do the next one, interest paid. We already worked that out earlier. There it is, 51,000. 51,000 cash outflow. Dividends paid? Well, for that, we're going to use note 3 to the cash flow statement. Let's go down to note 3, and let's go to our information. The first thing we need to know is how much did we owe our shareholders from last year? For that, we must look at shareholders for dividends. Here is our shareholders for dividends. And what we owed them at the end of last year was 192,500. So we're going to start by saying amount owing at the end of previous year, 192,500. Now we need to look at the total amount of dividends that we declared and paid this year. So we're going to go to our dividends information here. It says interim dividends were paid 32 cents per share. Final dividends 24 cents per share. Now we have to consider, do these dividends include or not include the new shares that were issued? Well, remember that dividends are declared and paid, well, paid in the middle of the year and declared at the end of the year. These shares of 62,500 were issued at the beginning of the year. So both the interim and final dividend will include these shares. Therefore, we use the full 750,000 shares. And we'll say that the full amount of shares declared and paid for this year were 750,000 shares times 32 cents plus 750,000 shares times 24 cents. When I say cents, I should put a little C there for cents. Therefore, the amount of rands, so I guess it would be better to put them in not 32 cents, but 0.32 rands and 0.24 cents. Let's do that. 0.32 rands and 0.24 rands. And that should give us if I've done this correctly, 450,000 rand. 750,000 rand times by 420,000. That gives us 420,000 rand. That is our total amount declared and paid. Let's put that in our cash flow statement. Dividends paid and recommended, 420,000 rand. And finally, we have to subtract the amount of dividends that we did not pay for this year. That is the dividends we still owe at the end of the year, which is 180,000 rand. So we're going to put in our cash flow statement 180,000 rand as a cash outflow, or rather as a reduction of the cash inflow that would have happened from the full dividends amount. If you sum those, you will get 432,500 rand. We can put that 432,500 in our dividends paid as a cash outflow. We're going to do a similar calculation for taxes paid. Taxes paid, we'll use note 4 to the cash flow statement. Let's go to our information. How much tax did we owe SARS at the end of the previous year? It says at the end of the previous year, or beginning of the current year, there was a credit of 60,000 rand in our SARS income tax account. A credit balance means it was a liability, which means we owed them. So we started by owing SARS 60,000 rand. So amount owing to SARS at the end of the previous year, 60,000 rand. Then, how much tax did we calculate was for this year in total? Well, we'd have to go here to our income statement. Net profit before tax, income tax. This is the one. 520,000 rand. So let's put that here. Oh, they've got dividends paid and recommended. No, that should say tax for the year. Or income tax, you could say. Income tax for the year, or income tax, it's fine. I'm going to write here income tax, 520,000 rand. How about the amount that we still owed them, or that they owed us, at the end of the financial year? Well, it turns out we don't owe them. They owe us at the end of the financial year. We know they owe us because it's a debit balance, which means it's an asset. So if they owe us, do we have to consider that a cash inflow or a cash outflow? Well, we paid 15,000 too much. 15,000 we would not otherwise have had to pay. So we must consider it a cash outflow, a cash outflow. So we are going to add it, not subtract it. If we had not paid all of the amount, that is, if we owed SARS at the end of the year, we would minus that from the total income tax that we paid for the year. So now, considering we paid more than we needed, we have to consider it as more taxation paid for this year. So the total taxation that we paid for this year is 595,000 rand. Let's put that in our income statement. Cash outflow from taxes paid, 595,000 rand. Let's now calculate our total cash flows from operating activities, 373,000 rand. All right, the long one is done. Let's do the quick ones. Cash flows from investing activities shows the cash flows that come from buying and selling fixed assets, including fixed deposits that mature. Let's start with the fixed deposits. That's the easy one. Our investment in fixed deposit went from 190,000 to 260,000, which means we increased our fixed deposit by 70,000. Now, was that a cash inflow or a cash outflow? Well, we would have had to pay money out of our bank account and into our fixed deposit account. So it is a cash outflow. So we go here, financial assets or changes in financial assets, 70,000 in brackets. It is a cash outflow for us. Now let's look at our fixed assets. Firstly, we saw that our land and buildings increased. Sorry, increased? Yeah, increased. It increased by 28,000 rand. Equipment, did it increase or decrease? It increased by 149,000. However, that could be a mixture of both purchasing and selling. Let's see if we sold sold equipment or anything this year. We did sell equipment. We sold it at a book value of 18,000, but the cost price of that was 29,000. So when we are looking at how much equipment we bought, we have to minus 29,000 from our changes in equipment. So we went from, I'm going to write it up here, equipment of 640,000. We then sold, how much was it? 30,000 maybe? We sold 29,000. We then sold 29,000 rands worth of equipment. Then we bought some other amount, which gave us, at the end of the financial year, 789,000 rands worth of equipment. So let's work backwards. I'm going to do it on my calculator. 789,000 rand minus 640,000 rand plus 29,000 rand gives us 178,000 rand of purchases of equipment. So we purchased 28,000 rand of land and buildings. We purchased 178,000 rand of equipment. So our purchases of fixed assets will be 178,000 plus 28,000. Let's see if we got that right. 178,000 plus 28,000. There it is. Which gives us a total cash outflow, because we purchased these fixed assets, of 206,000. We also have the proceeds from the sale of fixed assets. So proceeds from sale of, not purchase of, proceeds from sale of fixed assets. And we sold fixed assets worth, what did it tell us here? 18,000 rand. 18,000 inflow. If we sum these, we get 258,000 rand of outflow as a result of investing activities. So we have operating activities done, investing activities done. Now let's do financing activities. So I just want to check we still have sound here. Yes, we do still have sound. That's good. Hopefully we've had it the whole time. First, let's look at our let me just say that the things that affect our financing activities are changes in shares, changes in loan. So we usually see that as three lines: proceeds from the issues of shares, repurchase of shares, and changes in loan. Let's start with the easy one and look for any changes in loan. Mortgage loan, there you go. It went from 450,000 to 410,000. Here's mortgage loan. We had a decrease in our mortgage loan of 40,000 rand. Oopsie, I made a mistake there, sorry. 40,000 rand. Let me just scroll back across again. And let's see if we got that right. There you go. Repayments of loans, an outflow of cash of 40,000 rand. That's what happens when you pay off a loan. Your cash goes out of your bank account. So it's a cash outflow. Now how about proceeds from from issuing new shares? And repurchasing of shares. Does it say anything about issuing shares? Yes. Does it say anything about repurchasing shares? No. Here is the information about our shares. We issued 62,500 new shares. If we go up to so what we need is the amount of ordinary share capital that increased because of the issue of those new shares. And if we look at the ordinary share capital, it went up from 2,770,000 to 3,050,000, which means we had an increase of, what is that? My brain is not wanting to do this in my head. 280,000, I think. Is that a 280,000 increase? Why does this thing keep bothering me? There you go. There you go. All right. So let's go here. 280,000. Sure enough, there it is. Proceeds from issue of share capital. So we can sum these figures and find that our cash flow from financing activities is 240,000. If we now sum our cash flow, all three cash flow activities, cash flow activity number 1, cash flow activity number 2, cash flow activities number 3, you sum those and you will find your net change in cash and cash equivalents to be 355,000 Rand. Now we need to double check that that's right by looking at the change in our cash and cash equivalents throughout the year. So let's go to note 2. And let's look at our cash and cash equivalents. In our information, we know that the bank amount changed from negative 110,000 Rand to positive 0. No. This is our bank overdraft figure, which means we went from minus 110,000 to 0, and then from 0 up to 240,000. See, cash at bank. So we had a total change of 350,000 Rand. Negative 110,000 up to positive 240,000. That is bank overdraft up to cash at bank. So it's a total change of 350,000 Rand. So here is our starting figure for bank of negative 110,000 up to our ending figure for the year of positive 240,000, so a net change of 350,000. But there are other cash and cash equivalents too. We have petty cash, which changes from 5,000 to 10,000. 5,000 to 10,000, which is a 5,000 increase, which means our net change in cash and cash equivalents must be 355,000 Rand. And does that line up? Yes, it does. 355,000 Rand. So whether we work, as I like to say, top down, or whether we work bottom up, we get the same figure, which is what must happen. And just like that, we have finished this cash flow activity. I hope that was helpful, and for my grade 12s, I wish you luck for tomorrow's test.